Welcome back to the deep dive. You gave us a pretty fascinating puzzle to solve, the wild extremes of the S&P 500 in 2025. So today, our mission is to really deliver the concentrated truth behind the market's most spectacular successes and its most crushing failures.
Exactly. We're sort of skipping the headline. S&P return, what was it, 17%?
Around there, yeah.
Because that number, it really hides the true story.
Yeah.
I mean, 2025 wasn't one market. It was two completely different environments playing out at the same time.
A tale of two markets.
Absolutely. On one side, you had companies providing the essential, the infrastructure for the global AI boom, and they just went parabolic. On the other side, you saw these former growth darlings.
Yeah.
And their high expectations just violently collided with macroeconomic reality and, frankly, brutal competition.
And the numbers really define the drama here. The biggest winner gained almost 600%.
Incredible.
And the worst loser, down over 68%. So this deep dive is all about giving you the precise catalysts, the strategic takeaways behind the 6 stocks that really define these extremes: SanDisk, Western Digital, and Micron on the winning side.
And then the Trade Desk, Fiserv, and Alexandria Real Estate Equities on the losing side.
Let's unpack this crucial divergence. Okay, so let's start with the stocks that absolutely soared. The theme of this segment seems pretty simple. If you are essential to AI's ability to process and store data, you are untouchable.
It was more than just a regular boom. I mean, the source material points to a genuine supercycle.
A supercycle.
Yeah, the kind of exponential growth required for training and deploying these massive language models.
Yeah.
It meant cloud providers were just spending money, almost regardless of minor economic wobbles.
Yeah.
They simply had to have the memory and storage. It wasn't optional.
Leading the charge, and this is maybe the most explosive story of the year, is the newly independent SanDisk Corporation, SNDK. It clocked in at an unbelievable 585% rise, the top S&P 500 stock. It debuted in February around $38.50 and ended the year trading in the $240 to $260 range.
A 6-fold return. Just think about that.
So what was the catalyst? What drove that?
What's so fascinating here is that the catalyst was entirely strategic. The spin-off from Western Digital early in the year.
Right.
That one move freed SanDisk to concentrate exclusively on high-speed corporate SSD solid-state drives that are just, perfectly designed for these hyperscale data centers.
So they stopped being a consumer device company.
Overnight, they became a pure-play AI infrastructure provider.
Yeah.
And the market just completely underestimated the speed of that pivot.
Yeah, the numbers back that up. Their Q1 revenue jumped 21% to $2.3 billion, and their earnings per share of $1.22. It more than doubled what analysts expected.
Right. The street was still pricing them like a regular old hardware maker.
Yeah.
They didn't realize SanDisk was now the key solution to the AI speed bottleneck.
Strong cash flow, low debt. The source documents mention almost zero bankruptcy risk.
Exactly. The momentum was just purely from that global AI build-out and the scarcity of high-performance memory chips.
So what's the outlook for 2026? Is it still a buy?
Well, analysts still favor a buy, but we have to remember the history here. The memory sector it's notoriously cyclical.
Boom and bust.
Always. JP Morgan was quick to issue a warning, basically saying that if this massive AI build-out slows or if new supply catches up too fast, margin pressure is going to be an immediate risk.
Okay, let's move to the runner-up, Western Digital, WDC, up a staggering 289%.
Nearly quadrupling, yeah.
And it earned itself a place in the NASDAQ 100 by the end of the year.
WDC is just a classic example of unlocking hidden value. Their success was, you could say, dual-pronged.
Okay.
First, you had the core business, the high-capacity hard disk drives, the HDDs. They saw a massive demand from cloud providers who need huge, reliable, and cost-effective storage.
Right, for archiving all that AI training data.
Precisely. And the second prong was
The SanDisk spinoff.
the SanDisk spinoff. By separating the fast-growing but also volatile flash business, that's SanDisk, and focusing WDC purely on the stable, high-margin HDD segment, they streamlined everything and unlocked all this trapped value for investors.
And it looks like management tried to signal their confidence, too. They reinstated dividend payments, announced a huge $2 billion share buyback.
That sends a powerful message. It confirms they see the business as structurally stable and, a cash-generating machine.
But was that signal alone enough to justify a nearly 300% surge?
No. It confirmed what the market was already believing. And the financials backed it up. Cloud infrastructure revenue grew 31% to $2.5 billion, And importantly, their gross profit margin shot up from 37% to 44%. They are the core pick-and-shovel provider for the AI boom, right alongside their main rival, Seagate.
But what stands out to me here is the valuation. Despite this huge run, WDC is still seen as reasonably priced, trading at a forward PE below 25.
Yeah, which makes it significantly cheaper than a lot of the other high-flying AI stocks out there.
All right, finally for the winners, we have what some are calling the hidden champion of the year. Micron Technology, MU, up 228%.
Tripling its price, pushing its market cap over $300 billion. It was a huge year for them.
And Micron's surge wasn't a slow climb, was it?
Not at all. It was a dramatic turnaround for the entire semiconductor memory market. And the secret sauce here, it's one acronym, HBM.
Wait, HBM high bandwidth memory. Can you briefly clarify why that specific type of memory is so critical? Is it just capacity, or is there a speed component the AI models rely on?
It's pure, unadulterated speed.
Ah.
Think of standard DRAM as like a regular highway connecting the processor to the data. HBM, by contrast, is a dedicated hyperloop. It lets the specialized GPUs used for AI training access data vastly quicker.
So it solves the bottleneck.
It is the solution to the bottleneck. And because Micron was solving that problem, they became incredibly valuable.
And the results were monumental. Quarterly revenue soared 56% year over year.
And net profit surged an astounding 175%.
Wow. Gross margin jumped from 38 to 56%. That's a huge shift in profitability.
And here's where it gets really interesting. Despite that massive 228% gain, the forward PE remained incredible. Yeah, this segment is a perfect trilogy of failure, really. You've got competitive erosion from structural shifts, total management shock, and then a sector-specific financial crisis fueled by interest rates.
Leading the collapse, down approximately 68%, is the programmatic advertising platform, The Trade Desk, TTD. The stock fell from over $100 to the $30 to $40 range.
The Trade Desk was the absolute definition of priced for perfection.
No room for error.
None. So when growth decelerated that sharply, I mean, falling from 30 to 40% down to, was it, low double digits?
Yeah, that's cliff.
The market just it executed them. The real structural problem lies with what they call the walled gardens.
Can you explain that concept, walled gardens, in this context?
Absolutely. The walled gardens are the massive platforms like Amazon DSP and Google. They own both the advertising space and the user data.
So they control everything.
And they're increasingly keeping ad budgets inside their own ecosystems. TTD is an intermediary, an independent platform, and these giants just grew so aggressively that they eroded TTD's market share and squeezed the budgets available to them.
The sources also mention a specific investor distrust related to internal stability.
Yeah, there were reports of key executive departures, rumors about the CFO or COO leaving.
Which just fueled skepticism about the company's direction while it was facing these huge headwinds.
It's a classic case of valuation pressure meeting structural risk. And even after cratering, the stock's PE was still high, around 50.
Still pricey.
Right. The market is signaling that even at this reduced price, TTD's model faces long-term challenges, and its premium valuation just isn't justified anymore. Now, they're still profitable, so there's no bankruptcy risk, but the growth story is, for now, broken.
Okay, sharing that bottom spot, also down about 67%, is the Fintech giant FISV. Their fall was, it was truly dramatic, peaking near $238 in March, only to end the year in the $70 to $80 range.
And the killer blow was that single-day 42% crash in October.
42% in one day. That's institutional chaos.
It is. When you see a drop that violent, it tells you the market's trust in management has just evaporated. The crash was triggered by a second consecutive growth guidance cut.
A second one.
Cutting guidance once is a warning. Doing it twice in a row, especially for a massive company like this, it just signals that management cannot reliably forecast or execute their own business plan.
And the core merchant and Clover POS unit, that was supposed to be their engine of growth, it just stalled out.
Stalled. Hit by economic pressure on small businesses and just fierce competition from rivals like Block, Square, and Stripe.
And to make matters worse.
Right. To compound that operational disaster, FISV immediately announced a CFO change and appointed 2 co-presidents. It just signaled internal turmoil, desperation, and terrified investors even more.
The market cap just plummeted from over $100 billion down to between $30 and $36 billion.
But, this kind of violent repricing,
Mm,
It often creates a contrarian opportunity.
that's what I was thinking.
It absolutely does. Pfizer became extremely cheap, trading at a PE of just 8 to 10. Analysts estimate its intrinsic value is potentially $130 to $170 per share. They're saying it was historically oversold.
So 2026 is all about rebuilding trust.
Entirely. Rebuilding management credibility. But for value investors, this deep, deep discount on a company with such vast financial networks, it's a very attractive, albeit very high-risk bet.
And our final major loser for the year, Alexandria Real Estate Equities, are pretty. The specialty REIT down 49%. For a real estate investment trust, that level of distress, it signals a whole sector is in crisis.
That's because it was a crisis unique to the specialized lab and office real estate market.
What happened?
During the pandemic, the supply of life science real estate increased a massive 7.5 times since 2021, just driven by cheap money and optimism.
And then demand fell.
Demand fell 60%. So you had this enormous oversupply and rising vacancy rates in key biotech hubs like Boston and San Diego.
And on top of that, you had elevated interest rates, which made financing costs for REITs who rely on debt absolutely excruciating.
That financial pressure led to the most painful signal of distress for any REIT investor. In November 2025, they announced an enormous 45% dividend cut,
Ouch.
dropping the quarterly payout from $1.32 to 72 cents. For a company that's designed to pay reliable income, cutting the dividend that drastically, it's a defensive measure of last resort.
The cut was necessary, though, right, to save cash?
It was. To save about $410 million in cash, protect the balance sheet, and fund their portfolio rebalancing, which includes selling almost $3 billion in non-core assets in 2026.
So where does that leave the stock?
Well, it now trades at a massive historical discount to its net asset value, which analysts peg at $120 to $130 a share. FFO, or funds from operations, the REIT version of earnings, is projected to be negative in 2026.
So more pain to come.
Short-term pain is guaranteed. There's no bankruptcy risk, given the quality of the buildings, but it's a waiting game for patient investors who are buying assets far below their historical worth.
So let's zoom out here and synthesize these 6 completely different stories.
Yeah.
What does this massive divergence really tell us about 2025?
I think it means that the market just ruthlessly prioritized infrastructure over application when the macro environment got tight. SanDisk, Western Digital, and Micron. They provide the essential memory and storage that AI models must have to function.
They're insulated.
Totally insulated from the competition happening at the application layer. They get paid whether the trade desk wins an ad bid or if Pfizer sells one fewer POS terminal. It's the clearest example of the pick and shovel analogy in practice.
And the sources make a clear point that all these movements were driven by massive global factors. We're talking about the AI boom, the memory supply cycle, U.S. interest rates.
Exactly. Global competition in digital advertising and Fintech. The influence of specific local markets, like any news coming out of Turkey, for instance, was negligible. This is all about global capital flows and huge technological shifts.
And that global focus is key, which I guess guides the outlook for 2026. The triage seems clear.
It is. The winners, SNDK, MU, WDC, they're still attractive, but they face that inherent global cyclical risk of the memory market.
Right. Investors have to manage the fact that this demand spike might eventually plateau. You have to watch those earnings reports like a hawk.
Meanwhile, the losers, TTD, FISV, and RE, they've completely transitioned from being growth stocks to being high-stakes value or contrarian plays.
That's the critical distinction.
I think so. FISV and Alexandria are deeply oversold, but they're supported by strong underlying assets. Prime real estate for RE, vast payment networks for FISV, but they demand patience and a tolerance for structural risk.
And TTD and Pfizer have to prove their management is credible again.
They absolutely have to. If Pfizer just manages to meet its new lower guidance, the stock could rebound sharply because of that ultra-low valuation.
That's maybe the deepest insight here. So just to make sure we absorb this. A company that tripled its price, like Micron, is statistically cheaper than a company that cratered by 2/3, like the trade desk.
Exactly. And it means the market fundamentally believes in Micron's future earning power. It's projecting continued exponential profit growth. But it views TTD's future with extreme skepticism, even at a much lower price.
So it's not about the price you pay.
It's about the risk assessment of future cash flow. That's the difference between manageable cyclical risk and fundamental structural risk.
So what does this all mean for the year ahead? 2025 was a brutal lesson in repricing expectations. It seems success really depended on being strategically positioned for that one great global demand driver, AI infrastructure.
And the most challenging question for 2026 builds directly on that idea of intrinsic value versus market fear. Do the deep discounts you see in companies like Pfizer and Alexandria Real Estate, do they represent a once-in-a-decade buying opportunity on solid assets? Or are they value traps, signaling a fundamental long-term shift away from their business models? That's the question that will determine whether value or growth triumphs in the next 12 months.